Welcome. In this video, we are going to take a slow, gentle journey through the history of financial markets. We will begin early with some of the first known records of lending, credit, trade, and promises written down on clay tablets in ancient Mesopotamia. From there, we will move carefully across different places and centuries. Ancient trade routes, temples and merchants, Islamic commercial networks, medieval fairs, Italian banking houses, the rise of Amsterdam and London, rice markets in Japan, global exchanges, modern securities, electronic trading, financial crises, and the digital age. This is simply a story about how human beings learned to trust one another across distance and time, how people borrowed, lent, invested, insured ships, shared risk, built institutions, created money, and eventually built the markets that now quietly shape much of the modern world. The pace will be calm. Our goal is not to memorize dates or master technical terms, but simply to appreciate how financial markets evolve as a way for people to connect, exchange, and grow together. The goal is to listen, relax, and follow the long thread of history as it unfolds. So settle in. Let us begin, not with flashing screens or crowded trading floors, but with something much quieter, a promise, a record, and a world slowly learning how to exchange value. Before there were trading screens and stock tickers, there was something much simpler. There was a promise. A person had grain, silver, cloth, cattle, a ship, a future harvest, or a caravan preparing to leave before sunrise. Another person had a need, and somewhere between them, spoken quietly or pressed into clay, there was an agreement. I will give this to you now, and later you will give something back. That is not yet a stock exchange or a bond market, but it is the beginning of the same human story. Financial markets are, at their heart, places where people trade claims on the future. A loan is a claim on future repayment. A share is a claim on future profits. A bond is a claim on future interest and principal. A futures contract is a claim shaped around a future price. Even money itself can become a kind of promise, depending on who issues it and why people trust it. So, if we want to begin as early as we honestly can, we should not begin on Wall Street or in London. We should not even begin in Amsterdam, although Amsterdam will become very important later. We should begin much earlier, in the river valleys of the ancient Near East, where people kept accounts not on paper, but on clay. In Mesopotamia, thousands of years before modern financial markets, people recorded obligations on small clay tablets. Some of the earliest surviving economic records are not poems, not royal speeches, and not philosophical reflections. They are records of grain, silver, livestock, labor, land, taxes, deliveries, debts, and repayments. As early as around 3000 BC, Mesopotamian tablets recorded loans of barley or silver. These were not vague promises. They named quantities. They named dates. They named parties. They often included witnesses. It is worth pausing with that image for a moment. A small clay tablet, held in the palm of a hand, marks made by a reed stylus, a debt written down so that memory would not have to carry it alone. In a world without paper money, without banks as we know them, without a stock market, people were already using records to make the future more manageable. The tablet did not make the harvest grow. It did not make a borrower honest. It did not remove drought, illness, war, or bad luck, but it gave the agreement a form. It made the promise visible. In many ancient economies, credit was not a side detail. It was central. Farmers might need seed before the harvest. Merchants might need silver before a journey. Temples and palaces might collect, store, lend, and redistribute goods. Families might borrow in a difficult year and repay in a better one. Silver, in Mesopotamia, was often used by weight. Barley was both food and a unit of obligation. A loan might be made in barley and repaid after harvest. A loan might be made in silver and repaid according to agreed terms. Interest existed. Law codes and custom recognized it. We should be careful not to imagine a modern bank branch in ancient Babylon, but we can say with confidence that written debt, interest, collateral, and repayment schedules are very old, and that is one of the quiet truths of financial history. Markets begin when people become willing to separate time into today and tomorrow. Today I give. Tomorrow you repay. Today I risk. Tomorrow I may gain. Today I lend. Tomorrow I may regret it, or I may be rewarded. The ancient world did not have one single financial system. It had many local arrangements, many customs, and many forms of trust. Some promises were enforced by family ties, some by temples, some by rulers, some by written contracts. The deeper we go into history, the more careful we must be. There are things we know because they were written down. There are things we infer, and there are things we simply do not know. But from the surviving records, one thing is clear. Finance did not appear suddenly in the modern world. It grew slowly out of accounting, trade, storage, credit, and trust. Now imagine another ancient scene. A merchant from Assur, in northern Mesopotamia, sends goods across long routes toward Anatolia. The journey is difficult. Donkeys carry textiles and tin. Silver comes back. The road is long, and every mile contains uncertainty. The merchant cannot personally hold every coin, watch every warehouse, and stand beside every contract. He needs partners, agents, letters, accounts, and credit. At places such as Kanesh, in what is now Turkey, thousands of old Assyrian tablets have survived. They show a world of merchants, families, caravans, loans, repayments, and commercial correspondence. These were not financial markets in the modern exchange-traded sense, but they were networks of capital and trust stretched over distance. Distance is one of the great parents of finance. When trade is local, people can meet face to face. They can inspect goods, pay immediately, and go home. But when trade crosses mountains, deserts, seas, or political borders, money and goods no longer move together so easily. A merchant must send value ahead or receive value later. Someone must finance the journey. Someone must bear the risk. And so, across the ancient world, finance followed trade. In the Mediterranean, merchants faced the sea. The sea could make them rich, but it could also erase them without warning. A ship might leave port with wine, oil, grain, metal, or cloth. It might return with profit, or it might be lost to storm, piracy, accident, or war. One ancient answer to this uncertainty was the maritime loan, sometimes called a bottomry loan in later legal traditions. In a simple form, a lender financed a voyage, and repayment depended on the ship or cargo arriving safely. If the voyage succeeded, the lender was repaid with a high return. If the ship was lost, the lender could lose the money. This is an important step in the story. It is not merely lending. It is lending with risk sharing. The lender is not just asking, will the borrower repay? The lender is also asking, will the ship survive? In ancient Greek and later Roman maritime commerce, such arrangements helped merchants and shipowners handle the uncertainty of long-distance trade. Again, we should not force modern labels onto the past too eagerly. These were not futures exchanges or insurance companies in the modern sense, but they show something very familiar: finance as a way to price risk. Risk is another parent of financial markets. A farmer worries about harvest. A merchant worries about shipwreck. A lender worries about repayment. A ruler worries about war expenses. A city worries about grain supply. A family worries about dowry, inheritance, and debt. Financial contracts appear wherever uncertainty meets planning. Ancient Greece also gives us the image of the agora, a public space where trade, conversation, and civic life overlapped. Money changers and lenders operated in commercial settings. Ports such as Piraeus connected Athens to wider trade routes. People borrowed for voyages, exchanged coins, formed partnerships, and argued over contracts. The financial world was still personal, still local in many ways, but it was becoming more specialized. Rome, too, had a complex world of lending, tax farming, public contracts, and private wealth. Roman elites lent money, cities borrowed. The state contracted with groups that collected taxes or supplied armies. There were partnerships and investment-like arrangements. But here we must be especially careful. You may hear people claim that ancient Rome had a stock market like a modern exchange, with shares widely traded in companies called Societates Publicanorum. The evidence for that strong claim is disputed. Scholars disagree about how far we can take it. It is safer to say that Rome had sophisticated credit, contracts, partnerships, and public finance, but we should not calmly pretend that it had a modern stock exchange. The ancient evidence does not support that with the certainty we would want. From Mesopotamia to Greece to Rome, we see some of the ingredients: written debt, interest, partnership, public contracts, maritime finance, money changing, and risk sharing. But we do not yet see the modern stock market. We do not yet see large numbers of strangers buying and selling standardized shares on an organized exchange. For that, the story has to travel further. Let us move eastward for a while, because the history of finance is not only a European story. In China, long-distance trade and state administration created their own financial innovations. For centuries, Chinese coins were often bronze or copper pieces with holes in the center, so they could be carried on strings. This was practical for small transactions, but heavy for large ones. A merchant moving across great distances did not want to carry enormous strings of coins. During the Tang Dynasty, merchants used instruments later known as flying cash. These allowed value to be transferred across distance without physically carrying all the coin. The details changed over time, and historians describe these instruments carefully, but the basic need is easy to understand. When money is heavy and travel is risky, a written claim can be lighter than metal. Then, during the Song Dynasty, China developed what many historians describe as the world's first true paper money. In Sichuan, private merchant notes emerged before the state took a larger role. The Jiaozi notes of the Song period are an important milestone in monetary history. A note is not the same as a coin. It depends on trust in the issuer, trust in redemption, trust in the system around it. Paper money is not a financial market by itself, but it changes the environment in which markets live. It asks people to believe in a symbol. It makes payment easier. It also creates new dangers: overissuance, inflation, counterfeiting, loss of confidence. This pattern will return again and again. Finance makes trade easier, and then finance itself must be governed. The tool solves one problem and creates another. Across the Islamic world, from the early medieval centuries onward, trade routes connected cities across the Middle East, North Africa, the Mediterranean, Central Asia, and the Indian Ocean. Merchants needed ways to move value, extend credit, form partnerships, and settle accounts across long distances. In this world, instruments such as the sufdaja helped transfer funds from one place to another. Other forms of written obligation and payment instruction also developed. Partnerships allowed one person to provide capital and another to travel or trade. Trust was built through reputation, kinship, legal norms, religious law, and merchant networks. The Islamic commercial world mattered deeply to the history of finance because it connected regions. Goods, silver, gold, credit, contracts, and information moved through cities such as Baghdad, Cairo, Damascus, Basra, Tunis, and later through ports around the Indian Ocean. It is not accurate to tell the history of financial markets as if Europe invented everything in isolation. Europe inherited, borrowed, adapted, and transformed many older practices, just as other regions did. Now let us return to medieval Europe, slowly. After the fall of the Western Roman Empire, European finance did not vanish, but the scale and form of commercial life changed. Over time, trade revived and expanded. Towns grew. Fairs became important meeting places. Merchants traveled between regions. Coins varied from place to place. Rulers minted money, changed its content, and sometimes debased it. Moving value across borders was difficult. This was the world in which the medieval bill of exchange became powerful. A bill of exchange allowed a merchant in one place to make payment through a correspondent in another place, often in another currency and at a future date. It helped merchants avoid transporting large amounts of coin. It also allowed credit and currency exchange to be woven into one instrument. Picture a merchant in Venice who owes money in Bruges. Rather than carry silver across Europe, he deals with a banker or merchant house that has relationships in both places. Paper, trust, and accounting replace the dangerous movement of metal. This was not modern banking exactly, but it was getting closer. It required networks. It required reputation. It required record-keeping. It required courts or merchant customs that could enforce obligations. It required people to believe that a piece of writing in one city could become money in another. The fairs of Champagne in medieval France were among the great meeting points of European trade. Merchants came from different regions. Goods were sold, accounts were settled, debts were cleared. Money changing, lending, and exchange contracts became part of the rhythm of commerce. In Italy, especially in cities such as Venice, Genoa, Florence, and later Milan, financial techniques became more advanced. Italian merchants and bankers did not merely move goods. They moved claims. They handled deposits, loans, bills, partnerships, and government debt. One important medieval contract was the commenda. In a typical form, one party provided capital, and another undertook the journey or trading activity. Profits were shared according to agreement. The investor could participate in trade without personally traveling. The traveling merchant could trade with capital he did not fully own. This helped spread risk and connect people with money to people with opportunity. Again, we hear the same quiet theme. Finance links the present to the future, and one person's capital to another person's action. The Italian city-states also developed public debt markets. Governments needed money for war, defense, public works, and administration. Instead of relying only on taxes collected immediately, they borrowed. Citizens and investors could hold claims on future public revenues. In Venice, Florence, and Genoa, government debt became an important financial instrument. In Genoa, the Casa di San Giorgio, founded in the early 15th century, became a remarkable institution connected to the management of public debt and creditor rights. Claims on public debt could be transferred. Investors could own pieces of future payments from the state. This is a quiet but enormous development. A financial market does not require a company. It can grow around public debt. In fact, for much of financial history, government debt has been one of the most important securities in the world. Before many people bought shares in companies, many investors bought claims on states. This created a complicated relationship between finance and power. Governments needed lenders. Lenders needed governments to survive and honor their debts. When trust was strong, public debt could trade at better prices. When trust was weak, borrowing became expensive or impossible. The story now begins to move toward the modern exchange. By the 16th century, European trade had expanded dramatically. Oceanic voyages connected Europe, Africa, Asia, and the Americas in new and often violent ways. Empires grew. Colonies were seized. Precious metals crossed oceans. Commercial cities became centers of information and credit. We should say plainly, without turning this calm story into a harsh one, that many fortunes in early modern finance were tied to colonial extraction, monopoly, forced labor, and slavery. That is part of the real history. Financial markets did not grow in a morally clean room. They grew in the world as it was, with beauty, invention, ambition, cruelty, risk, and greed all mixed together. In Antwerp, a great commercial city in the Low Countries, a purpose-built bourse opened in 1531. Antwerp became a center for merchants, bankers, bills of exchange, commodities, and public finance. The Antwerp bourse influenced later exchanges in London and Amsterdam. It was not a stock exchange in the fully modern sense of continuous trading in corporate shares, but it was a major step toward organized financial meeting places. A bourse mattered because it concentrated people and information. If merchants know where to meet, prices become easier to discover. If bankers, brokers, and traders gather regularly, deals become easier to arrange. The market becomes not just a practice, but a place. London followed with the Royal Exchange, opened in the 16th century under Queen Elizabeth I. It became a center of commerce, modeled in part on Antwerp. But in London, stockbrokers would later spend much of their time not in the Royal Exchange itself, but in coffee houses nearby. There is something wonderfully human about that. Before modern finance had terminals and regulated trading floors, it had rooms filled with coffee, smoke, gossip, newspapers, handwritten lists, and men leaning over tables. News mattered, rumor mattered, ships arriving mattered, wars mattered, weather mattered. A merchant who heard news first might trade first. Now we arrive at one of the great turning points, Amsterdam in the 17th century. In 1602, the Dutch East India Company, known by its Dutch initials VOC, was formed. It was granted a charter for Dutch trade in Asia. To finance long and risky voyages, the VOC raised capital from investors. Unlike earlier ventures that might be organized around a single voyage and then wound down, the VOC became a more permanent joint stock company. Investors could own shares. Those shares could be transferred. And in Amsterdam, a secondary market developed where investors bought and sold those shares. This is why Amsterdam is so often called the birthplace of the modern stock market. There had been earlier credit markets, debt markets, commodity markets, and partnership arrangements. But Amsterdam brought together a large joint stock company, transferable shares, regular trading, brokers, investors, price information, and an exchange environment. The VOC was not just a romantic adventure of ships and spices. It was also a monopoly power backed by the Dutch state, and its history includes coercion and violence in Asia. But as a financial institution, it changed the world. It showed that large, risky enterprises could be funded by pooling capital from many investors. It allowed ownership to become divisible. It allowed investors to enter and exit by selling claims to other investors. The share became a kind of liquid story. You did not need to command a ship. You did not need to personally inspect spices or negotiate at a distant port. You could own a small part of the company, and someone else might later buy that part from you. In 1609, Amsterdam also established the Wissel Bank, or Bank of Amsterdam, to help bring order to a world of many coins and uncertain metal content. It offered a stable accounting and payment system for merchants. The bank helped Amsterdam become a trusted financial center. Trust, once again, sits at the center. A coin can be clipped. A ruler can debase currency. A borrower can default. A ship can sink. A rumor can spread. A market is always asking one question in many forms. Whom do you trust, and at what price? By the late 17th century, Amsterdam had active securities trading sophisticated enough to inspire Joseph de la Vega's 1688 book, Confusion de Confusiones, one of the earliest known books devoted to the stock exchange. It described traders, speculation, and the strange emotions of markets. Even then, people were learning that prices do not move only because of facts. They move because of fear, hope, leverage, rumor, and crowd behavior. Modern investors sometimes imagine that market psychology is new. It is not. The tools change, the screens change, the speed changes. Human emotion remains. In the 18th century, financial markets spread and deepened. London became increasingly important. The Bank of England was founded in 1694 as a private bank that acted as banker to the government. Government debt, banking, and securities markets became closely connected. Britain's wars and empire were financed through taxes, loans, bonds, and institutions that could mobilize capital at large scale. In London, brokers gathered in coffee houses. Another London coffee house became important in a different but related way. Edward Lloyd's Coffee House, near the Thames, became a meeting place for ship owners, merchants, captains, and people willing to underwrite maritime risks. Out of that world grew Lloyd's of London, one of the most famous names in insurance. Insurance belongs beside financial markets because it is also a market in uncertainty. A ship might arrive safely, or it might not. A cargo might survive, or it might be lost. One person might not want to bear that entire risk alone. So risk was divided, named, priced, and shared. The insurance market did not replace courage. It did not calm the sea. It simply allowed merchants to face danger with a contract in hand. In that sense, insurance and securities markets are close cousins. A bond prices the risk of repayment. A share prices the uncertain future of a business. A futures contract prices a future commodity. An insurance policy prices the possibility of loss. These instruments are different, but they all do something deeply human. In 1698, John Castaigne began publishing a list of stock and commodity prices at Jonathan's Coffee House. That small act, a price list, belongs in the history of markets because markets need memory. A price today becomes a reference point tomorrow. Price information turns scattered deals into a visible market. Eventually, in 1801, the first regulated exchange in London came into existence, and the modern London Stock Exchange was born. France had its own dramatic financial story. In the early 18th century, John Law, a Scottish financier, became central to a bold experiment in France involving paper money, a bank, state debt, and shares in the Mississippi Company. The system expanded quickly, and speculation grew intense. In 1720, the Mississippi bubble collapsed. That same year, in Britain, the South Sea bubble burst. The South Sea Company had been tied to government debt conversion and to a trade monopoly connected with Spanish America, including the slave trade. Investors bid its shares to extraordinary levels, and the collapse became one of the great early financial crises. The year 1720 reminds us that financial markets can do two opposite things. They can mobilize capital for real activity, and they can also detach imagination from reality. A share is a claim on something, but during a bubble, people may stop asking carefully what that something is. They may buy because others are buying. They may believe that a rising price is proof of wisdom. They may confuse motion with value. This pattern is old. It will appear again in canals, railways, mines, land, emerging markets, radio, automobiles, conglomerates, dot-coms, housing, crypto tokens, and things not yet invented. Each age believes its excitement is new, the costumes are new, the rhythm is ancient. While European stock markets were developing, another major chapter was unfolding in Japan. In Osaka, rice was not only food, it was also a measure of wealth and obligation. Samurai stipends were often connected to rice. Rice brokers and merchants developed active markets around rice bills. In 1730, the Tokugawa shogunate officially authorized trading at the Dojima Rice Exchange, including rice futures. Dojima had features that looked surprisingly modern: membership, clearing functions, and organized rules. The Dojima Rice Exchange is one of the great reminders that futures markets did not begin in Chicago. Chicago would become central later, especially for grain, but Japan had a sophisticated rice futures market in the 18th century. A futures market is built around a simple problem. The future price is uncertain. A farmer worries that prices may fall by harvest. A buyer worries that prices may rise before supply is needed. A trader sees opportunity in the difference between today's expectations and tomorrow's reality. Futures contracts allow people to agree now on terms for later delivery or settlement. This can reduce risk. It can also invite speculation. Often, it does both at once. The 19th century brought a new scale to financial markets. Industrialization required enormous capital. Canals, roads, mines, mills, railways, steamships, telegraphs, and later electrical systems demanded more money than most individuals or families could provide. Joint stock companies, bond markets, banks, and exchanges helped gather savings from many people and direct them toward large projects. The railway age is especially important. Railways were expensive to build, visible to the public, and often promoted with great optimism. In Britain, railway shares became objects of intense speculation in the 1840s. In the United States, continental railways relied on bonds, land grants, and investors at home and abroad. In India, Latin America, Russia, the Ottoman Empire, Egypt, and many other regions, railways were financed through combinations of local power, foreign capital, government guarantees, and international markets. This was the age when finance became visibly global. A saver in London might own a bond connected to a railway in Argentina, a government loan in Egypt, a mining company in South Africa, or a canal somewhere far away. Capital crossed borders, but so did risk. A crisis in one place could affect investors in another. News from a distant government, harvest, war, or default could move prices in financial centers thousands of miles away. The 19th century also widened the bond market. Government bonds became familiar instruments for investors in many countries. Sovereign borrowers, railway companies, canal companies, mining ventures, and municipalities all came to market looking for funds. In some cases, the money built lasting infrastructure. In other cases, it fed corruption, over-optimism, or default. This is why international finance has always had a double face. It can connect savings to useful work across borders. It can also allow distant investors to ignore local realities. A bond sold in a comfortable office may be tied to a railway through difficult terrain, a government with fragile revenues, or a mine dependent on labor conditions the investor never sees. The paper may look clean, while the world behind it is complicated. By the late 19th century, financial centers were linked not only by capital, but by habit. Investors watched London, Paris, Berlin, Amsterdam, New York, and other centers. They compared yields. They read newspapers. They followed cables. A crisis could begin with a bank, a war scare, a harvest failure, or a rumor about a government's ability to pay. Financial history is often a history of connection, before people fully understand the consequences of being connected. Financial markets were becoming a nervous system. Information moved faster because technology moved faster. Telegraph lines changed the tempo of trade. A price did not have to travel only by ship or horseback. News agencies used telegraph networks to transmit market information. In 1851, Paul Julius Reuter opened an office in London's financial district and transmitted stock market quotations and news between London and Paris over the new submarine telegraph cable. The speed of information changed what a market could be. Before the telegraph, distance created delay. After the telegraph, delay shrank. Prices in different cities could be compared more quickly. Arbitrage became faster. Rumor traveled faster too. Calm and panic both found new wires to run through. In 1867, Edward Callahan invented the stock ticker, a machine that printed stock prices on a narrow paper tape. The ticker turned market movement into a continuous stream. Traders no longer needed to be physically present at the exchange to receive every price by messenger. The market could begin to enter offices, brokerage rooms, and later homes. The ticker tape was almost poetic, a thin ribbon of changing numbers carrying excitement, fear, fortune, and loss. Commodity markets also became more organized. In the United States, the Chicago Board of Trade was founded in 1848 as a cash market for grain, and forward contracts began trading there early in its history. Chicago's location mattered. Grain from the American interior moved through the city. Buyers and sellers needed standardized grades, reliable delivery, and ways to manage price risk. Over time, futures exchanges became central to agricultural and commodity finance. Wheat, corn, cotton, coffee, sugar, metals, energy, and many other commodities would develop markets where producers, consumers, merchants, and speculators met through contracts. Again, the same idea. The future has a price, or at least people try to give it one. Around the world, formal stock exchanges multiplied. The New York Stock Exchange traces its origins to the Buttonwood Agreement of 1792, when brokers in New York organized securities trading rules. The Paris Bourse took shape under state regulation in the 18th century. The Bombay Stock Exchange, formally established in 1875, became Asia's oldest stock exchange. The Tokyo Stock Exchange was established in 1878 during Japan's Meiji era. The Johannesburg Stock Exchange was formed in 1887 during South Africa's gold rush. These exchanges were not identical. They grew from different legal systems, economies, empires, states, commodities, and local needs. But they shared a family resemblance. They gathered buyers and sellers. They standardized rules. They turned private negotiation into something more public, more visible, and more repeatable. The late 19th century was also the age of the classical gold standard. From the 1870s until the outbreak of the First World War in 1914, many major economies tied their currencies to gold. This created a framework for international payments and exchange rates. It did not eliminate crises. It did not make the world fair or stable for everyone, but it gave global finance a shared monetary language. Under the gold standard, central banks, gold reserves, interest rates, capital flows, and confidence were tightly connected. A country losing gold might raise interest rates. A financial panic might force a defense of reserves. Investors watched not only companies, but currencies and governments. The market for government bonds became one of the great measures of trust. If investors believed a state would repay, it could borrow cheaply. If they doubted, yields rose. This remains true today. Between the world wars, another institution appeared in the landscape of international finance. The Bank for International Settlements was created in 1930, first connected to the settlement of post-war reparations, and then increasingly associated with cooperation among central banks. It was not a stock exchange. It was not a place for ordinary investors. But it reflected a reality that had become impossible to ignore. National money systems were connected, and central banks needed ways to speak, settle, and cooperate. Modern financial markets do not live apart from central banks. Interest rates, bank reserves, liquidity, currencies, and payment systems all shape the background in which securities trade. A stock exchange may look like the stage, but often the deepest machinery is somewhere quieter, in clearing systems, central bank accounts, collateral rules, and settlement practices. The early 20th century disrupted the old order. The First World War strained the gold standard, government finances, and international capital flows. States borrowed heavily, markets closed or were restricted. Inflation and debt reshaped economies. After the war, attempts to restore the old monetary order were fragile. The 1920s brought technological excitement, consumer credit, stock speculation, and uneven prosperity. Then came 1929. The Wall Street crash of October 1929 did not by itself cause the entire Great Depression, but it became its most famous financial symbol. Stock prices collapsed, banks failed, credit contracted, international trade fell. The pain spread across countries. The crisis revealed how deeply connected finance, banking, production, employment, and confidence had become. In the 1930s, many governments responded with new regulation. In the United States, the Securities Exchange Act of 1934 created the Securities and Exchange Commission, giving it broad authority over securities markets, brokers, exchanges, and disclosure. Other countries also developed their own regulatory structures over time. The lesson was not that markets should disappear. The lesson was that markets need rules, disclosure, supervision, and trust. A market without trust eventually destroys itself. After the Second World War, another international financial order was created at Bretton Woods, New Hampshire, in July 1944. Delegates from 44 nations agreed on a new system that included the International Monetary Fund and what became the World Bank. Currencies were fixed but adjustable, and the U.S. dollar was linked to gold for official purposes. This system reflected lessons from earlier monetary disorder, depression, and war. It sought stability. It also reflected the power realities of its time. For roughly a generation, the Bretton Woods system shaped global finance, until the early 1970s, when the dollar's convertibility into gold ended and major currencies moved toward floating exchange rates. In the 1950s and 1960s, another major layer of global finance grew offshore, the euro-dollar market. Despite the name, eurodollars were not euros. They were U.S. dollar deposits held outside the United States, especially in London and other international banking centers. This market helped banks and corporations borrow and lend dollars beyond the direct boundaries of the American domestic banking system. The euro-dollar market is less visually dramatic than a trading floor, so it is often less remembered by the general public. But it mattered enormously. It showed that money could migrate into spaces between national rules. It helped make post-war finance more international, more flexible, and sometimes harder to supervise. This is another recurring pattern. When rules are strict in one place, financial activity may search for another place. Markets do not only respond to prices, they respond to law, they respond to tax, they respond to regulation, they respond to geography. They flow toward opportunity, and sometimes toward shadows. Floating exchange rates changed financial markets again. Currencies themselves became more actively traded sources of risk. Companies doing business across borders had to think more carefully about exchange rates. Banks developed new products. Derivatives grew. The world of finance became more mathematical, more global, and more fast-moving. In the post-war decades, another quiet revolution occurred, the rise of institutional investing. Pension funds, insurance companies, mutual funds, university endowments, and later index funds became major market participants. Instead of markets being dominated only by wealthy individuals, merchant banks, or brokers, pools of savings from millions of workers and households entered the system. This did not make markets simple, but it changed who was indirectly involved. A teacher with a pension, a factory worker with retirement savings, a family with a mutual fund, a government employee with a retirement plan, all became connected to securities markets, whether they watched prices or not. In 1971, NASDAQ began operating as an electronic quotation system, and it would become strongly associated with technology companies and electronic markets. It did not begin as a modern internet trading platform, but it marked a major step away from the traditional exchange floor. In 1973, the Chicago Board Options Exchange opened, creating a marketplace for standardized, exchange-traded stock options. That same year, Fisher Black and Myron Scholes published their famous option pricing paper, and Robert Merton developed related work. The Black-Scholes-Merton framework helped change how traders, academics, and institutions thought about pricing risk. The rise of modern clearinghouses also deserves a quiet place in the story. Clearing is not glamorous. It does not usually appear in movie scenes about finance, but it is one of the reasons markets can function at scale. When many people buy and sell many contracts, someone must make sure obligations are matched, margins are collected, defaults are managed, and settlement occurs. A good clearing system is like good plumbing. People notice it most when it fails. From early exchange rules to modern central counterparties, the story of markets is also the story of reducing the fear that the person on the other side of a trade will disappear. That fear is ancient. The tools for managing it have become more elaborate. Derivatives were not new. Futures and options had existed in various forms for centuries. But the combination of organized exchanges, clearinghouses, mathematical pricing, computing power, and institutional demand made modern derivatives markets expand dramatically. A derivative is a contract whose value depends on something else: a stock, a bond, an index, an interest rate, a currency, a commodity, or even a measure of volatility. Derivatives can hedge risk. They can also magnify risk. Like most financial tools, they are neither angels nor demons. Their effect depends on structure, use, leverage, transparency, and the incentives of the people using them. The late 20th century brought deregulation, globalization, and computing. In London, the financial reforms known as the Big Bang in 1986 transformed the structure of the market, ending old fixed commissions and changing the ownership and technology of securities dealing. Around the world, trading floors gradually gave way to screens. Open outcrop pits survived in some places for a time, but the direction was clear. Markets were becoming electronic. A trader no longer needed to hear a shout across a crowded floor. Orders could be entered through terminals. Prices could update in fractions of a second. Later, algorithms could respond faster than human eyes. Exchanges became technology companies as much as meeting places. Meanwhile, ordinary investors gained new vehicles. Index investing, made famous for individual investors by Vanguard's launch of the first index investment trust in 1976, offered a simple idea. Instead of trying to beat the market, own a broad slice of it at low cost. Exchange-traded funds, beginning with products in Canada in 1990 and the first U.S.-listed ETF in 1993, added the ability to trade baskets of securities on exchanges throughout the day. This was another democratizing step, though not a perfect one. It lowered costs and broadened access. But access to markets does not automatically create wisdom. The easier trading becomes, the more important patience and judgment become. The 1990s and early 2000s brought the internet into finance. Online brokerages allowed individuals to trade from home. Financial data became widely available. News moved instantly. Message boards, television, and later social media changed the emotional environment of markets. The dot-com boom showed the old bubble pattern in new clothing. Companies connected to the internet attracted enormous enthusiasm. Some became lasting giants. Many vanished. Once again, investors had to learn that a real technology can produce unreal prices. Then came the global financial crisis of 2007 and 2008. This crisis did not begin with one simple cause. It involved housing markets, mortgage lending, securitization, leverage, derivatives, credit ratings, short-term funding, regulatory gaps, global capital flows, and misplaced confidence. Mortgages were packaged into securities. Securities were held by banks and investors around the world. Institutions relied on funding that could disappear quickly if trust broke. When U.S. housing prices fell and mortgage losses grew, the damage spread through the financial system. In September 2008, Lehman Brothers filed for bankruptcy. Panic intensified. Credit markets froze. Governments and central banks intervened on a massive scale. The crisis moved through the United States, Europe, and beyond. It became a global recession. The 2008 crisis reminds us of something ancient. Finance is built on promises, and promises depend on trust. When trust vanishes, even sophisticated institutions can become fragile very quickly. After the crisis, regulation changed again. In the United States, the Dodd-Frank Act was signed in 2010. Around the world, regulators focused more intensely on bank capital, derivatives clearing, systemic risk, consumer protection, and the question of which institutions were too important to fail disorderly. No regulatory system removes risk, but every major crisis leaves behind new rules, new memories, and new blind spots. In the years after 2008, another experiment appeared: Bitcoin. In 2008, a paper under the name Satoshi Nakamoto described a peer-to-peer electronic cash system. In 2009, Bitcoin began operating. Its design aimed to allow online value transfer without relying on a traditional financial institution as intermediary. Bitcoin and later crypto assets opened a new chapter in the history of financial markets. Some people saw them as money, some as technology, some as speculation, some as protest, some as infrastructure, some as a bubble. The truth has varied by asset, use, time, and person. What matters for our story is that crypto returned to one of the oldest questions in finance. Can strangers trust a system without trusting each other? Mesopotamian tablets trusted witnesses and seals. Medieval bills trusted merchant networks. Amsterdam trusted ledgers, brokers, and institutions. Modern exchanges trust clearinghouses, regulators, banks, and code. Bitcoin proposed a different kind of trust, built through cryptography, incentives, and a public ledger. Whether one admires or doubts it, it belongs in the long story of people trying to record, transfer, and price claims. The 21st century also brought market access to a scale earlier generations could hardly imagine. A person sitting at a kitchen table could buy a global index fund. A small business could receive payments across borders. A trader could follow markets in Asia, Europe, and America in a single day. A central bank decision in one country could change mortgage rates, currency prices, commodity prices, and asset valuations far away. But more access also meant more responsibility placed on individuals. Earlier markets often excluded most people. Modern platforms invite them in. That invitation can be empowering. It can also be dangerous when speed, emotion, and leverage meet in the same hand. The old coffeehouse rumor did not disappear. It became a post, a headline, a push notification, a viral chart, a message in a forum, a short video, a screenshot of a gain or loss. The medium changed. The psychology continued. By the early 21st century, financial markets had become almost invisible because they were everywhere. A company raises money by issuing shares in New York, London, Hong Kong, Mumbai, Frankfurt, Tokyo, Sao Paulo, Johannesburg, or Toronto. A government sells bonds to investors across continents. A farmer hedges crop prices. An airline hedges fuel. A pension fund buys global equities. A central bank changes interest rates, and markets around the world respond. A currency moves because of inflation data, political risk, trade flows, or expectations about future policy. An individual buys an ETF on a phone. The market is no longer only a place. It is a network of places, machines, laws, contracts, institutions, and beliefs. And yet, beneath all the complexity, the old themes remain simple: time, risk, trust, information, greed, fear, hope, memory. The clay tablet and the trading app are separated by thousands of years, but both exist because human beings want to move value through time. Both ask the future to meet the present. Financial markets have helped build railways, ships, factories, homes, farms, technologies, and cities. They have also financed wars, empires, extraction, speculation, fraud, and ruin. They are not purely good or purely bad. They are mirrors of human organization. A market can be a tool of patience, helping savings become productive investment. It can be a tool of insurance, helping risk move to those willing to bear it. It can be a tool of discovery, bringing many opinions into one price. But it can also become a theater of illusion, where people pay more for a story than the story can ever repay. That is why financial history is calming in an unexpected way. At first, markets seem noisy. Prices flash, headlines shout, fortunes rise and fall. But when we step back across centuries, the noise softens. We begin to see patterns. We see that every generation believes it is living through something completely new, and in some ways, it is. But we also see that the emotional structure of markets is very old. Someone borrows before harvest. Someone finances a caravan. Someone lends to a ship. Someone buys a claim on a city's taxes. Someone trades a bill in a medieval fair. Someone buys a share of the VOC. Someone speculates in London or Paris in 1720. Someone agrees on a future rice price in Osaka. Someone buys a railway bond. Someone reads a stock ticker. Someone calls a broker. Someone clicks buy. Different centuries, similar hopes. The history of financial markets is not just the history of money. It is the history of how human beings learn to cooperate with strangers across time. That cooperation is fragile. It needs records. It needs law. It needs reputation. It needs honest information. It needs limits. It needs memory. When memory fades, old mistakes return under new names. So perhaps the quiet lesson is this: markets are not magic. They are agreements. They are promises made tradable. They are trust made visible as price. And prices are not always truth. Sometimes they are a careful estimate. Sometimes they are a crowd's excitement. Sometimes they are fear. Sometimes they are manipulation. Sometimes they are the best available signal in an uncertain world. The market is powerful, but it is not all-knowing. That humility is important. The people who pressed loan contracts into clay did not know they were beginning a story that would lead to stock exchanges, central banks, ETFs, derivatives, and blockchains. They were solving immediate problems: a harvest, a debt, a shipment, a payment, a promise. Most financial innovation begins that way, not as a grand theory, but as a practical answer to a human difficulty. How do we move value safely? How do we share risk? How do we raise money for something too large for one person? How do we know what something is worth? How do we trust someone far away? How do we plan for a future we cannot see? Every age answers in its own language. Clay tablets, sealed envelopes, sea loans, bills of exchange, public debt ledgers, coffeehouse price lists, stock certificates, telegraph wires, ticker tape, exchange floors, clearinghouses, central banks, index funds, electronic order books, distributed ledgers. Each technology changes the surface. The questions remain. And that is where we can end our journey for now, not with a final answer, but with a long view. Financial markets began before coins were universal, before paper money, before banks, before nation-states in the modern sense, and long before computers. They began when people discovered that trust could be recorded, divided, priced, transferred, and sometimes sold. From the river cities of Mesopotamia to the merchant routes of Asia, from Mediterranean sea loans to Islamic payment networks, from Italian bills of exchange to the bourses of Antwerp and Amsterdam, from Osaka rice futures to London coffeehouses, from railway bonds to telegraph wires, from gold standard capital flows to regulated exchanges, from electronic markets to crypto ledgers, the story is vast. It is international. It is imperfect. It is human. And it is still being written. Somewhere right now, a person is saving for a future they hope will arrive. A company is raising capital for an idea that may or may not succeed. A farmer is worried about next season's price. A government is borrowing from citizens and strangers. A trader is watching a number change. A family is investing quietly for a child. A programmer is building a new kind of ledger. A central banker is thinking about trust. The tools are modern, but the feeling is ancient. We stand, all of us, somewhere between today and tomorrow. And financial markets are one of the ways humanity has tried to build a bridge between the two.